All right, welcome back, chart addicts. Make sure to hit the like button because the Federal Reserve just cut interest rates by 50 basis points. You heard that right, people. We got the 50 basis point hike. Now, there was rumors kind of getting floated around about um, really just 50 basis point cuts was kind of something I thought was just some hype news that was coming out to try to get markets to overreact ahead of the real news. But it seems like the labor market weakness that the Fed's been observing with unemployment going up has kind of put them in defensive mode. And so we talked about the dual mandate of the Federal Reserve, which is maximum employment and price stability. So price stability is keeping inflation under control and keeping the purchasing power of the dollar stable. So it doesn't change all the time. We kind of have a more stable expectation of the dollar's purchasing power. Now, they've kind of been over the last 3 to 4 years, they've shifted their perspective, or they've shifted their priorities from maximum employment over to fighting inflation because obviously it had run out of control. Now, with inflation, according to the government, down to 2.5%, and unemployment starting to peak its head up above 4%, now the Fed seems to have shifted their priority from fighting inflation to, kind of getting the economy stimulated, because it seems like there's some weakness in the economy. And the only reason that they would do a 50 basis point cut, by the way, is if we're in serious trouble. So if we're already in a recession or headed into a recession, that's a pretty good reason for the Fed to start cutting rates, especially, when we just got our first real solid inflation print at that 2.5 mark. So overall, I'm excited to see what Jerome Powell has to say. 50 basis points was an unexpected move. So I actually have to refer to our YouTube stream from earlier because I'm pretty sure the CME Fed Funds futures expectations has changed since earlier. So let's actually go ahead and use this beautiful resource. By the way, all the trades played out perfectly, these trades that we were looking at. So we had these expectations. There was a 25 basis point cut. That was kind of scenario one. That's what I was expecting personally. But we ended up getting a 50% cut. I said short-term bearish, medium-term bearish, long-term bullish. This current action right now is short-term bullish. But I think over the next week, 2 weeks, we're going to start to see the markets really come back down once the realization hits that the only reason we got a 50 basis point cut is because we're in serious trouble, right? Because they really could have started easing back to 25 basis points and done 25 at a time. And then once we're kind of in the clear on inflation, they can start going more aggressive. But this aggressive off the jump is either sort of like, you don't really want to dip your toe in the cold water. You want to just jump right in. And so I think this is, but that I don't really expect the Fed to do stuff like that. This really seems to me like a response to the economic weakness. Okay, so short-term bullish is kind of what we're seeing now. Long-term, medium-term, we're probably going to have some bearish action. Let me see the Fed funds futures. I think we covered that early on the streams right here. All right, so let's take a look at this. The expectation of a 25 basis point cut. Oh, wait. It's a bit too late here. Okay, so there was about a 55% chance of a 25 basis point cut. And then there was, there was a 45% chance here of a 25 basis point cut. And there was about 55% chance of what we just got. So it was really half and half. The Fed funds future market was really betting on a 50-50 split between a 25 cut and a 50 cut. The 50 cut ended up pulling through. And I think all these expectations of the future cuts are going to start to be in question. Because right now, the markets are betting on 25 at a time. They kind of want what the market wants, and what the market is expecting is for the Fed to kind of ease into this rate cutting cycle. Now, the biggest questions that they're going to ask Jerome Powell at this press conference is, can we expect a 50% or 50 basis point cut at every meeting now? And Jerome Powell is going to probably refuse to answer. He's going to say something like, we don't like to discuss what's going to happen at future meetings, but we're going to be data dependent. And if the data suggests we should do 50, then we'll do 50. But if it doesn't, then we won't. All right. Um, yeah. All right. If you're just tuning in, quick update. London workshop. It says September 30th, but it'll likely be October the 2nd. We're going to try to kind of put it on a weekend so everybody can show up. There's no conflicts with work. Make sure you guys click the link in the description. Pre-register for the London workshop. We also have Croatia and Barcelona. All right. So make sure that you guys are registering. We're doing the world tour. We just had 2,000 people in Colombia. Shout out to Bogota and Medellin. We're good. We're hitting Europe next. London, Barcelona, Croatia, and then of course the FX Summit in Dubai. If you guys are in Latin America, you can't make it to Dubai, make sure to pre-register for the FX Summit 2025 in Latin America. All the links are in the description. Use promo code Chartaddicts. I'm going to put in a sell position here. I'm going to put in a small sell position here and just kind of ride this thing down. We're back at the 886 Fibonacci, and so
Order filled.
my God, that is obnoxious. I'm going to keep my eye on this to see if these next few candles flip. If we end up creating support here and starting to push bullish, I'll close the trade and I'll end up just coming back for another entry. Shorting this is very risky. I would not recommend this for most traders. This is just me following the strategy. It's back at my sell zone. We've had this massive wick rejection. I think that the market could likely play around here until Jerome Powell hits the stage. So this is a bit of a riskier trade, but it is what it is. All right, so we're going to discuss here what the implications are for the overall economy. But until Jerome Powell hits the stage, we're not really going to have a lot of market action. Volume check, check, check. Okay, we're good. All right, we got about 5 minutes until
Order
Jerome.
filled.
Whoa, we got about 5 minutes until Jerome Powell hits the stage. All right, I'm going to close out of my. Wait, 1 second. I'm going to set my stops above these wicks here. All right, so if the market does push, I want to be out if it fills. And the downside target is basically just a fill of this whole move, getting corrected back down and kind of having this thing close below these highs. Very risky trade. Wouldn't recommend it for most. This is just sort of like a small risk trade that I put on and looking to just catch this rejection back down. All right, so the trades from earlier, we're just going to discuss these real quick. So we had these short position. Well, first we had this long position early in the morning. This was an absolute banger of a trade, hit all three of our take profit zones. Then we ended up taking this short position here at 513. So first we had the first push down and we hit the first take profit zone, took profits. Market came all the way through to the previous highs to hit the double top, and then ended up shooting down and even hit, all three of the take profits on that trade. And then we had a buy limit order that was at the inverted head and shoulders that we discussed on the stream earlier. If I can show you guys this trade here. So at the end of the stream, this is kind of where we were at. We had the short positions sitting. The zone was at 513, but we ended up taking some at 500. And then we had this inverted head and shoulders. And so what I was expecting was a buy position at the inverted head and shoulders, which is at 19,440. So I had sent out this markup in our group chat for Chartaddicts members. And so the buy position was at 19,441. That was the inverted head and shoulders zone. What ended up happening is the market whipsawed all the way down to the zone. Okay, whipsawed all the way down to the zone and then shot up to hit all 50 of the take profits. Okay. Absolute banger. Great trade overall. We had 3 back-to-back trades, and then even this short position now should be in some slight profits, but I'll be looking to close this thing soon in case we end up creating some sort of support up here. All right. So just need to push down, and then I'll be able to secure some partial profits on this trade and be able to just kind of keep the show on the road. I might even use this consolidation right now as a chance to de-risk. Keep that running. I know this is a little bit messy. I'm going to clean this up here in a second. We got about 2 minutes until Jerome Powell hits the stage. 50 basis point cuts, big market mover. And then, of course, make sure to register for the upcoming workshops in Europe. If you guys are in London, Barcelona, or Croatia, or anywhere close to those, make sure to head out. Come check out these workshops. Get around some like-minded traders, see some institutional folks come and speak to the crowds, and learn a ton. Help move your trading forward. All right. Let's do Fed Live. And let's see if the Federal Reserve page posted this themselves. They should have. CNN News? No. Thank you. All right. We got the pre-music going. We got about 1 minute until Jay Powell hits the stage. I would recommend most of you, or most all of you, close out all positions before he starts speaking, and then wait about 30 minutes until after he's finished speaking to enter positions. The best trades typically happen the London session after the Fed meeting, not during the Fed meeting itself. And so don't feel rushed or inclined to trade just because the market is moving. Trust that the biggest movements happen right before the meeting. There's a lot of like, sort of up and down action during the meeting itself or a continuation of the trend. But during the London session after the Fed meetings is where we get the best trades. So don't rush it. And yep, Jerome Powell's on stage.
Achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions continue to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%.
Order filled.
Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment.
Stop hunt. Went up, hit the stops. That's why stops always got to be above the highest wick, but that was a little tough to enter at this double top here. But market's very likely to come down and fill this entire area, and so we might have another buying opportunity at these lows, same price as the trade from this morning.
Inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve
Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead?
What I tell you, first question.
Excellent. Thank you.
So, okay, a lot of questions in there. Let me jump in.
Thank you.
Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in?
What did I tell you all, man?
Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time.
Expect the dollar to rebound here. I know it looks like it's crashing, but short-term action does not mean that that's going to be the trend. So right now the momentum is bearish, but by the time the dust settles, when the day closes, I expect the dollar to have closed back above the 100.8 support. But obviously, we'll see how the cookie crumbles.
If that's appropriate, we can go slower. If that's appropriate, we can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where what the committee is thinking today, but the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove restriction. And we'll be looking at the way the economy reacts to that. And that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
If you're still in those shorts, they just milked. I would definitely take partial profits or just cut the trade at this point. It still has, I mean, it's got a lot of room to go. This thing could continue bleeding if you want to leave something running on the table, but that was a pretty nice drop there. So I would take advantage of that.
Weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SCP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. Now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing,
Great question.
And what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
I kind of read that as like a preventative measure, but we'll let this thing finish up.
Nick Timmer,
Make sure.
up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very around the world have cut many of them several times. We've waited. And I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Those are some solid technical questions. That's why they let them rip for like 3 or 4 extras. Those were really good.
And is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market. But this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's, our plan.
That's why they cut 50 basis points.
Celebrating, as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. And we're not hearing that from companies that that's something that's getting ready to happen. So we're not
Yet.
because, there is thinking that the time to support the labor market is when it's strong and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael.
What I really want to hear is someone ask, how much did the rate cutting decisions from the ECB and from the Canadian Central Bank impact the Fed's decision? Did they get pressure to do this because everybody else is cutting rates?
Market. You're pricing in basically by the end of next year, 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one, probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data, we'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend.
I think he just hinted that the immigration is what's causing unemployment rates to go up. It's not that less people have jobs. It's that there's so many new people entering the job market that it's skewing the numbers. That's huge.
Unemployment rate to rise, and the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more, how do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
There it is.
Yeah. So, this is my fourth presidential election.
For all you guys in the chat, here it is.
And it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that and we make a decision as a group. And then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with.
Just for the sake of following my plan, I'm not going to trade during the Fed meeting. And so even if this thing rejects my buy zone, I'm going to have to let it go. Just really following the plan is the most important thing. And so I'm going to follow my rules, but I'll be watching this thing and giving you guys updates.
And our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%.
Whoa, what do you mean order filled? I didn't have any
Reserve
orders.
effectively declaring a decisive victory over inflation and rising prices.
No, we're not. So inflation.
Oh, I had a buy limit. Wow.
What we say is we want inflation. The goal is to have inflation move
Order filled.
2% on a sustainable basis.
How many more orders do I have open?
We're not really, we're close, but we're not really at 2%.
No, that's it.
And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
That's how you accidentally make 0.6%, by the way.
Hi.
Well, not even an accident, because obviously the order was placed there deliberately, but I definitely thought I closed that order.
The persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want.
Look at that entry.
Which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not.
It's at the buy zone, but personally, I'm gonna stay out of this. I want to see if this thing breaks through. Like I said, London session is going to provide us the best opportunities. So no reason to rush any trades. I'm going to personally stay out of this one.
Challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is, let's look, when at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
I didn't really discuss it.
Chair Powell, Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves.
No, it depends on the interest rate that the Fed sets. If you cut rates, so will mortgage lenders. The bank will cut my mortgage rate if you lower the interest rate that they're paying.
Of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com.
If you did take the longs, I would secure partial profits now. TP1 got hit, but I would definitely secure partial profits now or forever hold your peace.
25 or 50, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do.
Did anyone in the chat take the long position or no?
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to.
All right, TP2 just got hit.
It will be
TP2 got hit. Make sure you guys are securing partial profits if you have not.
A bright line over which that might move that would dictate one thing or another. We'll look at each meeting. We'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be.
I just checked. Sorry, TP1 just got hit. That's my apologies.
Mandate goals. Yeah, so I can't say we have a bright line in mind.
I'm thinking I should have held that buy limit now.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent.
What type of woke question is this?
Why you view that so important?
Sure. So countries that are all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea. It is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
I was live trading on the stream earlier, but right now I'm just paper trading. This is all just paper trades. Because I wasn't going to take the long position as per my rules, and my trading plan says don't trade during the Fed meetings. So even though I have all these levels marked off just to get that itch out on paper trading here. But yeah.
With him on what those changes should be, if those have support on the board in a broad way that you're looking for. And if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
They got to start hitting them with the one at a time. This is crazy.
The answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is that's happening with my support.
Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. That we don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then the comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer, for the last question.
That was the most Dana White answer I've ever heard from Jay Powell.
Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth.
I vote for Dana White to be the press secretary for the Fed.
Risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and
She looks more worried than Jay Powell is.
inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision. And I think it should send a signal that that we're committed to coming up with a good outcome here.
They're going to replay that a million times. If this doesn't work out and inflation resurges, they're going to play that a billion times over.
So I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that.
Nah, C4 is going to be promoting slap fighting during the whole thing.
You see inflation coming down.
Or the John Jones Stipe fight.
Solid levels. So I don't really see that. No. Thank you.
Thank you.
Okay, rock solid close to the Federal Reserve press conference. Let's go through some main points here. Jerome Powell mentioned a lot of important things, both to all three: consumers, the market, and the overall economy. So 50 basis point cuts, according to what Jerome Powell is saying, is this is a preventative measure, and they're trying to be proactive instead of reactive. So traditionally, the Fed's job is really not to get involved all the time. It really is to react when necessary and to get the economy back on board. Now, because they've basically screwed up the whole game with the money printing that's been happening, the Fed doesn't really have the luxury to be reactive anymore, because by the time something breaks, it's too late. Because it does take months for Fed policy to sort of cycle through the economy. So preventative measure means everybody is seeing the labor market weakness. Everyone's seeing the economic conditions slowing down. And just like he said, if you own a business in America, you've definitely felt that there has been a slowdown in overall consumer demand. Now, the retail numbers did come out positive. Inflation did come back down to 2.5% according to the government numbers. And so, just like I said before, in the pre-meeting analysis call, the Fed had so much legroom and buffer because of that 2.5% inflation print that they were able to get away with a 50 basis point cut. And so they don't want to wait until we hit a recession for them to have to jump in. And I actually think this is a really smart move from the Fed, but I don't believe Jerome Powell when he says that there's no political motivation involved, because we're about a month and a half away from an election. And you don't necessarily want the country to be in economic turmoil during an election cycle. That just leads to a lot of chaos. All right. So I do think that there's a little political motivation there for them to keep the economy stable through November. Because of the rate cuts, we will see a bearish market. I won't say we will, but there's a high likelihood of a bearish market here. We'll do another call probably tonight or tomorrow, where I'll go back and show you all the rate cuts that have happened, probably starting in 2020, the ones all before 2020, and show you how the market has reacted each time. We'll typically see 1 to 2 months of bearish action following a rate cut. And that's not even because institutions are selling. Institutions might not even sell at these prices. What they'll do is, if they do shave anything off, is just to go into cash. They're not betting against the stock market. They just want to go into cash until things kind of subside, and then they're going to buy up all these assets at cheap prices. So when I told you guys that the bull run in crypto would start in November, it's around the same timeline as the election. It's around the same timeline as these rate cuts starting to seep into the economy. Same timeline as, the overall business cycle recovery. So I'm in favor of this medium-term bearish outlook, where we're just going to have a little bit of a retracement kind of through October. And then kind of coming up on November, we might start to see these rate cuts affect, the borrowing. People start to go out and get houses again. And I think overall, we'll have medium-term bearish, long-term bullish. All right. Institutions, I don't even think that they're going to be taking profits, because most of them, they are in profits for sure, regardless of where they were at. But this is really more to move money to cash, wait for things to settle down, and then around the election time, buy everything back up at discounted prices. And so the institutions might just kind of shave a little bit off the table. I think most of the selling pressure and buying pressure comes from the hedge funds who are trading on margin. Because you guys have to realize the overall, the actual stock market is big, but the derivative market, the futures, options, and swaps, those third-party derivative markets on top of the stock market makes up about 95% of the volume. So when you see these aggressive sells and aggressive buys, it's really just institutions that are levering up. So if it's hedge funds, they have a liquidity provider that allows them to leverage up. And if you're the top prime bank or liquidity provider, and you're kind of moving money around at the institutional level, at that level, then you're really allowed to create money out of thin air. Like Citadel's allowed to leverage up 15, 20 to 1, but they are the market maker. They are the liquidity provider. So we're seeing derivative-led pressure on the market. And if we do see a sell-off, it won't necessarily be the Fidelities and the Schwabs and the Merrill Lynches that are selling client assets, but it'll be like an initial sell-off of client assets, or just a pause in buying, which will then invite those, the risk parity funds and the high beta funds, all the algo funds, to basically become net sellers for a little bit. And then as soon as the discount becomes so attractive on indices that the institutions like Schwab, Fidelity, and those are ready to get back in, that's where we see real buying pressure. That's where recoveries come from. Put a number in the chat if that explanation made sense. It's a very kind of oversimplified explanation, but that's really how it works. There's obviously a million different factors that go into price movement, and that's like the entire game of markets, is what is moving price and what has the biggest impact. But in my honest opinion, I think that institute, like, because I worked at Merrill Lynch, and so we don't necessarily sell client assets when things go wrong. Okay, we tell them to hold the line and that to have a longer term outlook or a longer term approach. But we will stop buying as aggressively for sure. We might start buying, especially if we go into a bearish market, we might start buying up things or like well, we don't even do CDs. CDs don't even pay nothing. We'll probably do bonds. So if I had clients, multi-million-dollar portfolios each, and I was managing them, I wouldn't even necessarily shave anything off. But if they were moving money over, I wouldn't put it into the market right now. I would probably put it in bonds and hold it there until the market dipped down. And then I'd probably buy it up once I get a discounted price. Then we see 17K on NAS. Okay, well, maybe not that far down. The apocalyptic stuff isn't really my scene. But this trade was an absolute smasher. 19,428 got hit. Obviously, we experienced a little bit of drawdown, but we never even broke the previous low. Never had to use even 20% of the total drawdown that we had anticipated. And then now we're about to hit that final take profit here, which for CA members, this is TP2 right here. TP3 would be the previous highs up here. But TP2 is going to be about 19. Well, we're coming up on that right now, 19,570. Like overall, great trades today. If we can just kind of recap this before we hop off here. We had the buys early in the morning. Okay, that was a banger trade. All three TPs hit. We had the shorts off the 88.6 of this impulse. So we took these sells. I took first sell and the second sells. Got out obviously before the big spike. We had a buy limit. Again, just to kind of remind you guys, the buy limit that I had put up in the previous call was for that inverted head and shoulders right there at 19,441. That's exactly where this wick ended up hitting right before the news. 19,441 is right there. We had a beautiful spike up, and then it just kept spiking, broke all the levels. And I did have a short position that lost because I ended up having stop loss way too tight. Market liquidity grabbed and came in. So I took another sell position, closed out prematurely, and then I had a buy limit by accident. I had a buy limit by accident down here. Okay, had I held that, could I have squeezed out 540, the entry? Wow, that'd have been 140 points. And I think obviously I closed it for risk management purposes, but I did end up snagging, what was that, about 70 points. All right, so I could have doubled up on the profits I made, but that wasn't really my intention. My intention was to get out of that trade because honestly, I thought I had closed it. So we just hit that TP again. So not only did we hit this move, and then we hit the sell move, and then we also hit the buys right here, which is how we started the stream today at 19,428. And then we just hit that final target again. So almost every trade that we called today was a winner, except for, even the sells were a winner. The stop loss was just way too tight. I was playing it way too safe. But awesome stuff. All right, last thing, just let me know if you guys made money or not. Last reminder, make sure to register for the events. We also have the Barcelona, Croatia, and London workshops coming up next month. These workshops will teach you how to become a profitable trader. We'll bring some investing folks. We'll bring some folks to kind of, not really motivation, but more like lifestyle habits and sort of, I don't say habits of successful people. So we'll have multimillionaire folks that are really high functioning, kind of talking about how they are able to maintain such a high level of energy and sort of motivation and stuff. And yeah, it's going to be an absolute banger of a workshop. We're trying to hit 1,000 people minimum in each city. And so I'm hoping that you will be one of those. There's also a special surprise, potential free tickets to the FX Summit conference just for showing up to the workshops. And so that's the most important thing. Okay. Yeah, use promo code Chartaddicts to get discounted tickets on the FX Summit conference. And also, last but not least, FX Summit Latin America, where the early bird tickets are available. So if you guys want really cheap tickets on FX Summit LatAm and you guys want to snag those early, go ahead and snag those on the website. You can also use promo code Chartaddicts. Is there anything else to promote? Oh yeah, if you want a funded account from Apex Trader Funding, use the link in our description or just use promo code Chartaddicts for 80% off promo code Chartaddicts for 80% off. You guys want to stay in touch with us, go to the website, subscribe to our newsletter, and we'll keep you updated on all this stuff in writing, because who's going to remember all this? Great to see you guys. Happy and safe trading. If you made money, don't give it back. Walking away with the money is the name of the game. It's how you beat the odds. All right. Catch you guys on the stream tomorrow morning. Happy and safe trading. Peace. So